Listen up, folks. Time could be running out to lock in a historic yield at public.com. But you can lock in a 6% or higher yield with a bond account. Here's the thing. The Federal Reserve just announced a big rate cut, and the plan is for more rate cuts this year and in 2025 as well. That's good news if you're looking to buy a home, but it might not be so good for the interest you earn on your cash. So, if you want to lock in a 6% or higher yield with a diversified portfolio of high yield and investment grade bonds, you might want to act fast. The good news? It only takes a couple of minutes to sign up at public.com. And once you lock in your yield, you can earn regular interest payments even as rates decline. Lock in a 6% or higher yield with a bond account at public.com/investing unscripted. But hurry, your yield is not locked in until you invest. Brought to you by Public Investing, member FINRA and SIPC. As of 9/26/24, the average annualized yield to worst across the bond account is greater than 6%. Yield to worst is not guaranteed. Not an investment recommendation. All investing involves risk. Visit public.com/disclosures/bond-account for more info.
Hey everybody, Happy New Year and welcome back to Investing Unscripted, where even in another year, we are still asking and answering the hard questions about investing, personal finance, and more. I'm Jason Hall, joined by still, even in this new year, my good friend, the voice of the people, Jeff Santoro. Hey Jeff, Happy New Year.
Happy New Year, my friend, and all our listeners. Yes, this episode drops on New Year's Day. Kind of fun to have the big holidays on Wednesdays on our podcast day. We got a Christmas episode last week. We have a New Year's Day episode this week. If you need a break from your family, we are here for you.
When you need a break from your family, we're here.
We turned the volume down on this one just in case anyone had a little too much partying last night. Although based on the age of our average listener, I'm guessing maybe not too many people even made it to midnight. Not like
I think
we don't have a lot of 20-year-olds who listen to the podcast. Let's put it that way.
No, that's fair. I mean, I think we've reached the point where people wake up with sleep injuries, right? Not hangovers.
Yeah, I'm much more likely to pull a muscle sleeping than wake up hungover. That's true.
Yeah. All right. So the episode for today is, we wanted to be careful and not make it just like a derivative of some of the past few episodes that we've already done. We're titling it 2025 and Beyond. And while we're going to talk a little bit about what we expect in the new year and beyond, it's just really going to be more about kind of looking back a little bit, but also having some conversations about just like our basic investing principles and our frameworks and what we're going to be doing, not just what we're thinking.
Yeah. I don't know about you, but every time we get to the new year, partially because I always have some time off at the end of December and I can actually think and go through my finances and make end of the year decisions and thinking about moving forward. It's like a clean slate kind of a feeling. And I don't know, because I'm still evolving as an investor. Things are always changing. I do feel a little bit more settled this January than the last Januaries since I started on this fun stock buying investing journey a few years ago. But it does feel like a good time to think through, do I want to keep doing the same thing? Do I want to change anything? Do I want to reconsider how my portfolio's constructed? Do I want to do something incredibly boring and buy bonds in 2025? So it'll be fun to think through our processes, if anything's going to change, things that have changed even over the past year. You know, we talked about the past year a lot in the last couple episodes from like a macro perspective in the markets, but we didn't really talk about us and our processes. So we'll go in a bunch of different directions, a loose, unscripted conversation, if you will. Before we do that, I want to give a new year welcome to any new listeners and a new year reminder for all listeners. Been a little slow on the ratings and reviews side of things lately. So if you are an old listener, a new listener, a medium listener, and you could take a few minutes to give us a 5-star rating on both or either podcast, Apple Podcasts and Spotify, we really appreciate it. On Apple Podcasts, if you could take an extra couple minutes and give us a review, that would be even greater. That's how people find the show, other than just sharing it with them directly. So we would appreciate that.
You can do that. You can do that too.
Yeah.
The best Christmas gift, maybe this is something to think about for Christmas next year. Just give people a card with just Investing Unscripted written in it. And don't explain it, because what are they going to do? They're going to go look it up online.
Yeah.
They'll find us.
That is an idea.
Yeah.
All right. I have a question for you to start things off, Jason, before we get too into next year. I want to ask a question about right now. So one of the things that people do this time of year is do some tax loss harvesting, which we can talk about what that is in a second. But I was thinking about this recently, and I think every year in December for the past couple of years, I have used tax loss harvesting as an excuse to sell a stock I just wanted to sell. And I told myself, I'm tax loss harvesting. And I use that just to be like, oh, that's the reason I'm doing it. But if I really am being truthful, it was probably just I was itching to sell that stock anyway, and I had that as a reason. So I'm curious if you have ever felt that too, or if you think that's a legit thing, and maybe quickly explain what tax loss harvesting is, just in case anyone's unaware.
Yeah. So first of all, two things can be true at the same time, right? So I think that's probably the case with that. So what is tax loss harvesting? Just a real quick short definition is it depends on your filing status and that sort of thing. And this is within taxable accounts. Again, I'm speaking to U.S. investors. This is U.S. tax law. You can sell stocks at a loss, realize that loss, and use it in one of two ways. You can use it to offset gains and realize gains. Maybe you sold some stocks at a profit in a taxable account. You can offset gains to a certain level. You can actually, if you have excess losses beyond realized gains, you can actually offset a certain amount of just taxable income. It's capped. Talk to your tax professional or read about it in TurboTax or whoever your tax software is to get the specifics. But I think it's a useful tool. It really is, particularly using it to offset realized gains, because you can do more of that before, and then if you have any left over, you can offset taxable income, not just investing income. So I think it's a useful tool. But yeah, we're humans. We will convince ourselves that we're doing something good for a bad reason or doing something bad for a good reason.
It's interesting. I went back and looked in my account a couple days ago, and Fidelity has a pretty easy way you can look at just your closed positions for the year. So I was able to see where do I even stand? Do I have realized gains that I need to tax loss harvest?
Yeah.
And I don't. Everything I sold this year, on aggregate, what I sold this year was for a loss. So
right.
If I were to sell more, all I would be doing is lowering my taxable income to whatever degree that I can. One thing I think is interesting is people who do this, which is sell a stock at the end of the year that is down, but maybe one that they have not given up on.
Yeah.
And then, so then you get the tax loss harvesting with the intent to buy it back. Now you have to be careful, because if you do it within 30 days, then the tax loss harvesting doesn't count. It's called the wash rule.
Right.
But I could see a scenario where if I had massive gains in a given year, I'm thinking about a friend of mine who had a very, very outsized position in NVIDIA due to the run up it had this year. This is someone who had bought a ton of it in 2005, right? So he just had a whole bunch of NVIDIA, and then it quintupled in the past year or whatever, or 2 years. And he had to sell some. It was making him lose sleep. He was telling me about this recently, but now he's got this massive tax bill he's got to pay because it was all in this brokerage account.
Right.
So for someone like him, I could understand selling some other losers and then just setting a calendar reminder for 40 or 50 days later, just to make sure you don't go anywhere near the wash roll limit, and rebuying those shares so that you still own them, but you've taken that tax loss harvest. So that's just another way to think about it. Not any advice here. Knowing me, I would either forget to do it, or when I got to that day I was going to, I'd look at the price and I'd start anchoring, and then I wouldn't buy it or something like that. So
yeah,
I'd be careful, I do think, personally.
Broadly, and this is something that a few years ago, really, honestly, it might be close to 10 years ago, I first put this rule in place for myself. Number one, I think selling a loser that you've lost conviction in is generally the right move. And I don't mean it's fallen. You bought it a month ago and it's fallen, you're selling, or you bought it earlier this year and it's fallen, you're selling. No, you understand the business and you've learned that you were wrong, right? The thesis that you built was flawed. There's flaws in the business. Maybe something fundamentally changed, right? They made a big acquisition and now you're like, yeah, this is not what I signed up for. And moving on, right? You're moving on from the business, not just the fact that the stock has fallen. I totally love that, because if there's any one thing that kills me when I hear somebody say as an investor is I'm going to sell it as soon as I get my money back. Okay. So you want to sell it because you think it sucks, but you also somehow think the stock's going to go up. That is just that's wired human. It's like, I'm going to be right and I'm not selling it until I'm right. You know what I mean?
Yeah. No, I do that a lot.
Selling and moving on, I love it. And if your part of your justification is I'm going to do it before the end of the year and I can take the tax loss, that's great. I think it's great, because I think one of the things that investors don't do enough of is being smart about maximizing tax opportunities. Things like putting as much into your 401k as you can to lower your taxable base, putting into a Roth. Lots of idiots out there trading in taxable accounts, creating all these taxable events. And like, they'll sell a stock that is up 25% in a month. And that's taxed at your short-term gains rate, which is it's going to be taxed at your highest rate, right? So that 25%, if you're in a 30% tax bracket, that 25% gain is really like a 16%, 18% gain, right? It's not a lot of money. So people don't think through those strategies that can be worth massive amounts of money when you're putting your kid in a college, or you're ready to buy the boat, right? Or you want to buy the boat, or you retire, whatever, right? So
right.
I don't think enough investors are smart about those kind of strategies. But the rule that I put in place for myself, Jeff, is around selling to get the tax loss, but then buying back in. The problem is a lot of investors are doing this time of the year. So the risk is momentum going against you. So you, instead of selling in November, it's the last week of December and you're with the rest of the people that have been putting it off or been too busy. Now you're selling, and now there's momentum that's going to drive that stock higher over the next 30 days. So you book your loss, but then your cost basis, you sell it at $100 a share and it's trading for 110 when you buy it, right?
Right.
So the rule that I put in place is I have to buy it. If I'm going to play this game, I'm going to play it. I can't talk myself out of it.
Right.
If I sell and I get $1,000 back from my sell of that stock in 31 days, I'm going to buy $1,000 worth of that stock, whatever it trades for, not the number of shares that I bought. I'm going to reinvest that same dollar amount that I realized back into it. So that's my one like hardcore rule about this, because I will try to talk myself in or out of doing something stupid. So if it's going to be part of my process, I'm going to make it part of my process.
Hey, everybody. We'll be right back. But first, a word from our sponsors. Heads up, folks. Interest rates are falling, but you can still lock in a 6% or higher yield with a diversified portfolio of high yield and investment grade corporate bonds on public.com. You might want to act fast because your yield isn't locked in until the time of purchase. Lock in a 6% or higher yield with a bond account only at public.com/investing unscripted. Brought to you by Public Investing, member FINRA and SIPC. As of 9/26/24, the average annualized yield to worst across the bond account is greater than 6%. Yield to worst is not guaranteed, not an investment recommendation. All investing involves risk. Visit public.com/disclosures/bond-account for more info.
Hey, Investing Unscripted listeners. My name is Brett, one of the hosts of the Chit Chat Stocks podcast. If you love Investing Unscripted, we think you will love listening to Chit Chat Stocks. On our show, we research individual stocks, interview investing experts, and, well, chit-chat about investing every single week. From hot stocks such as NVIDIA and Celsius to hidden small cap gems, we have something for every type of investor. Follow the Chit Chat Stocks podcast on YouTube, Spotify, or Apple Podcasts and start discovering new investments today.
Yeah, I think personally, what I'm going to try to do this December is not do any tax loss harvesting. Because I don't need to. I know I could reduce my taxable income a little bit more. I don't know. I might
think it's only a few $1,000s that you can lower your taxable income by. So it's not like it's a lot of money.
Right.
If you're in a really high bracket, if you can drop your taxable income $3,000, that could be worth $600 or $700. That's not pocket. That's not small money. But generally, it's not a ton of money for most people.
Yeah. Yeah. Oh, we can move on. I just wanted to ask about that. I mean, if anyone listening to this, it's past the end of the year, so you can still tax loss harvest. You can do it at any point. It's just
I was going to say that
for 2025, not for 2024.
It's smarter to do it like in the summertime. Sell them in May, and then buy back in June or July.
Right. Yeah. All right. So here's a looking back question I have for you as we are entering the new year. Is there anything? Well, I know of one thing, and I know you'll probably talk about it. I guess I'll ask the question this way. What is different about you as an investor right now, well, as we record this, the end of 2024, that's different than how you were at the end of 2023? How are you different than a year ago?
To hear you, I'm 5 years older.
Yes. I did have a lot of fun this year at poking fun at your age, which is
advancing age. Yeah. So I don't think a lot of people realize, but I think we were actually in high school at the same time.
Yeah, like we're not that far apart in age, but you have boomer vibes. So I like to roll
I totally
with
have boomer vibes, and I have old founding father hair. So
yes.
Yeah, those two things. So what has changed about me? And it's funny, I'm being tongue in cheek about the advanced age thing, but I have really fully leaned into, and I wrote about it in last week's newsletter, that I don't need the Hubble telescope to see my financial goals anymore. Like I can see with binoculars, and because I can see it, and like I could sit down on the back of a napkin and I can figure out what do we need our portfolio to do, my wife and I and our son's college investments. What kind of returns do we need between now and when my son graduates from high school, when we're ready to retire? And it's really easy to see that the level of returns that I need are much, much lower than I had realized before really starting to really go through this math. And I'm lucky because of this great bull run that we've been on for the past 15 years. That's a big part of the reason that we're here now, right? A lot sooner than I expected. But what it means is that I'm able to be a lot more conservative in the event that we were to see a global financial crisis level thing, right? Where it takes the market 4, 5, 6 years to fully recover. There's a lot of people that, either were all stocks or a lot of stocks and a lot of real estate back in the late aughts.
Yeah.
That their retirement dreams were wrecked.
Well, if social media is any indicator, there's a lot of people like that now.
Yeah. Yeah.
God forbid. I don't want us to hit that level of a downturn. Don't get me wrong.
No.
I want a downturn. I want to buy some stocks for sale, but
right.
I don't want a GFC level downturn.
I'm not expecting or predicting anything close to that level of downturn. I'm just making sure that if something like that were to happen,
you're not screwed. Yeah.
I'm not screwed. And I have options now. The reality is that honestly, if we didn't have hyperinflation, that the Fed reacted with really, really high yields, pushing interest rates up, I don't know that I'd be making these same changes, because now I have options of cash and money markets and bond yields that are much, much higher, that mean that I can move into higher floor investments while still pretty aggressively investing for higher ceiling with the stocks that I own.
Let me invert the question then, looking forward. So you made pretty substantial changes. Like this whole moving to bonds thing all happened over the course of this year, and even the second half of this year, if I remember correctly.
Right. That's right.
Do you anticipate 2025 being a little more stable, so to speak, in the decisions you make? Or do you think you're going to hit the gas pedal a little bit more on the transition to bonds and maybe cash?
I think the percentages are about where I'm going to keep them, which with bonds is, call it 10%-ish, bonds and fixed income. So I've got some CDs that are 5-year and 10-year CDs that I'm putting them in the same category as the bonds. They're all kind of fixed income thing, even though the CDs are cash, they're FDIC insured, and the bonds are not. Like, I realize they're different asset classes, but what they're doing for me, the tool, the purpose they serve is the same. So I'm pretty set on around 10% of that, and generally around 10% of cash. I'm a lot higher in cash right now than 10%, Jeff. And that's partly because of some things that I'm starting to do with options, where selling calls, and I've had some stocks called away. So for those who don't know, if you sell a covered call, right, you have 100 shares of a company and you sell a call at a price. If the stock goes way above that, somebody else owns the right to buy the stock from you at the price that you sold the call at. So the shares get called away at that price. And I've had that happen with a few, with this crazy run up that we've had. I haven't run out just to buy those stocks back. I've sold puts, which means that somebody has given me money and I've given them the right to put the stock back to me at that price. So it's a price that I'm willing to pay. So if the stock falls below that price, the owner of the stock can put it back to me at the higher price of the option that they hold on me.
Need cash, but you need cash in your portfolio to do these things.
Yeah, exactly. So it's a cash covered put, which means that if it's $100 stock and I buy one option, that's 100 shares at $100. That's $10,000 in cash for that $100 block of stocks. Yeah. So like I said, you need cash to do that.
Right.
But the flip side is that I get, even if the stock doesn't get put to me, I get the premium, right? So it generates income in cash. So I've started working that more into my investing strategy. And it's not a big part of my portfolio, but it's become a bigger part just because of the cash that you kind of need to be able to do that.
Yeah, it's funny. So
What
when
about you?
I think a lot changed with me over this year, and I think there might be some changes moving forward. What's interesting about my situation is I've talked a lot on this podcast about how I was in index funds until 2020, and then I bought my first individual stock, and that's how I ended up here. But the piece of that I think is obvious when you think about it, but I don't think I've said it explicitly, is another way to think of that is if you think about the way my wife and I have invested since we were 22, like out of college, first jobs up until 2020, I would say it was overly conservative. Like I was always I was definitely in funds that were more conservative than they should have been in my 20s and in my early 30s and in my mid 30s and my late 30s, and my wife too. So I'm probably going to delay the transition to less risk like you did a little bit longer than you did, only because the riskier part of my portfolio is still the smaller part, if that makes sense.
I think you're doing the right thing too, though, because
like I felt like I had to catch up a little bit.
Yeah, well,
and at the time that I made that decision, there was no yield anywhere else. So like it's a little, like you said, it's a little different now.
I'm curious. So
wait, hold on. I want to just finish. Why don't I finish?
Okay.
Because I have one more thing to say, and then I want to hear your question. But for me, when I do decide to make that change, it will be tweaks to the non-stock part of my portfolio, unless it blows up for some reason and becomes an outsized part, which I don't anticipate. So for example, I would change my allocation in my 403b, or I would change the allocation of my wife's 401k. That's where I would de-risk so that I can still do the thing I like to do, which is buy stocks.
What I was going to ask you ties into this, and I'm just curious. I don't want to project and say what I think. I want to hear what you think first, and then I'll respond. You also have a pension that you'll be eligible for. That maybe that's a little bit of the higher floor for you. How has that has it at all, or how has it factored into your thinking?
Oh, that's a big part of it. I mean, look, if I'm beating myself up for being less savvy about my investing when I was in my 20s and 30s, but part of that was ignorance, but part of it was I don't think I felt the need to learn more about it because I knew I had the pension.
Yeah.
And if you work long enough and you're not like a super spendy person, like you can get by on your pension and then eventually Social Security income. Like I know plenty of people who do that. And then if you have a little bit in a 403b that you put away too. So yeah, that is absolutely a reason that I'm okay considering how conservative I was. You know, on my wife's side, like she wasn't conservative in the amount she invested. Like she did the right thing. She put in her company's match, and then every year when she got a raise,
it was the allocations that were
right. And it was nothing bad. Like she was in a target date fund for most of the time, which is great. That's fine. I wish like I had known and she had known, maybe pick a target date fund a little further out, right? So it's a little more risky earlier on than, which is some advice we've heard from other people. So yeah, the pension is absolutely, I think the way I like to think about that now, and this just occurred to me in the last several months, and I'm sure I've said it here before, I think of the pension as like the cash, what will be the cash, instead of having a massive amount of cash in my retirement years, like a lot of people keep 3-5 years worth of just cash in cash, just in case there's a market
predictable
downturn.
Thing that the value and it's not going to change much and it's going to cover your costs.
So for me, my pension income once I retire can serve that function. It's like, that's how I'm thinking of it. The other thing I did this year that I said I was going to do for a long time is I finally paid a fee-only financial advisor to have a look at our entire retirement situation, just to make sure I wasn't missing anything huge. And luckily I wasn't. So I'm also in fine shape and reaching my goals and all that kind of stuff. She did recommend a little more bond exposure, which was smart and prudent. And I don't disagree. I think I'm going to just wait a little bit longer.
You're just ignoring her.
Yeah, just absolutely ignoring her. Well, the target date fund that my wife's 401k was in, I changed her allocation into a S&P 500 index fund for the last maybe year and a half. And her recommendation was like, not even right now, but eventually go back into the target date fund again, kind of like flip the switch back the other way, which kind of makes sense. So that's something I'll think about down the road.
I'm curious. Did you Did you just change the allocation or did you reinvest the existing principal?
Just change the allocation.
Yeah. Okay. That's what I thought. Yeah.
So I just left it, which,
right.
Yeah, I didn't want to completely.
So that just
de-risk.
started to increase the exposure to equities without erasing the existing bonds.
Exactly. Yeah.
Okay. Yeah.
And by the way, that the target date fund amount is still far larger than the S&P 500 amount, because I've only been doing that for the last couple of years, and she had been contributing to the target date fund for decades. So I don't know how much will change for me moving forward other than whatever normal evolutions happen to me as an investor. I do anticipate I will be less active in 2025 than in the past, because I was less active in buying stocks in the last couple months of 2024. Now, if we see a market downturn, that could change. That's kind of what I'm waiting for. I think 2024 was a pretty formative year, I think, for me. It's the first year I felt like I really knew what I was doing. And I hope that in 5 years, I look back and think, nope, you didn't. Because that means I kept learning. But it did feel better on that front than the previous couple of years did.
So Jeff, I've got a question here for you as we pivot to continuing to look forward, because this is something that's really crystallized for me over the past few years. When you're looking at your portfolio, when you're looking at your total wealth, your goals, what are you measuring against? How do you measure success?
I mean, I've always been, and this is even how I viewed it before I had this awakening in 2020 where I realized I was obsessed with all this stuff. Like, my goal has always been, I want to be able to retire and live comfortably. And I also want to be able to do that while paying for as much of my kids' college as possible. I think those are like number one and number two in terms of my long-term goals. And when I started buying individual stocks, I always sort of viewed that as, and if I can get lucky and find like a 10 bagger in there, and then at some point maybe use that to, I don't know, pay for a nice vacation, do a renovation on my house, buy a boat. Just kidding. I would never buy a boat. Then that's like icing on the financial cake is always how I looked at it. And I think that has helped me not make stupid investing decisions. Like, when I see what's out on social media and the way people talk about investing, and even people I have conversations with, I don't want to be like old man waving my fist at the clouds, but like when I talk to younger people I know who do invest in some way, it's a lot of either overt or under the surface, this vibe of I'm going to find the next Nvidia and get rich, and sure, good luck. Like, I know people do and can, but I've never viewed it that way. And I think, again, because I didn't get into buying individual stocks till I was so much older, but my goal has always been the super long term. And then if I can get any bonus out of my brokerage account, the way I kind of think about it is this: I'm not so sure I'm going to be able to pay every dime of my kids' college. It depends where they go. It depends what kind of scholarships they get or things like that. But if I get to the end and there's a little bit left over that needs to be paid for, and I'm in the position to sell some stock to cover it, then I might consider that. But that's not the reason I bought the stocks. You know what I mean?
Right.
It's sort of like if I'm looking at like the whole pie of my brokerage account and my IRA as like money I can use in retirement. And then if I can leverage any of it sooner for any other big expense, cool.
Hey everybody, we'll be right back, but first a word from our sponsors. FinChat.io is the complete stock research platform for fundamental investors. They have all the standard financial data on more than 100,000 stocks globally. But beyond that, they have company-specific segment and KPI data on around 1,800 stocks. So for example, do you want to see NVIDIA's data center revenue growth? They've got it. Do you like to track Apple's iPhone sales? They've got that too. Or how about nights and experiences booked for Airbnb? You guessed it, they've got it. And they just added around 8,000 ETFs and mutual funds to the platform. The breadth of FinChat's data is truly one of a kind. I use FinChat every single day as I'm researching the stocks in my portfolio, specifically when I want to see how they're doing on KPIs that FinChat is famous for. So to get 15% off any paid plan, go to finchat.io/unscripted. That's finchat.io/unscripted to get 15% off any paid plan today. The link will be in the show notes. Hey, Investing Unscripted listeners, this episode is brought to you by our friends at Yellow Brick Investing. Yellow Brick is an aggregator of the best stock pitches across the internet. By tracking thousands of blogs, newsletters, fund letters, podcasts, and more, they're able to collect and summarize the best stock pitches from all over and bring them to you in one single place. Think of it like a modern value investors club. I have to say, this is pretty cool. I can just type in the company I'm interested in and get a bunch of different stock pitches from across the internet. It helps me think through new ideas and find opposing points of view on the stocks I'm interested in. And the best part is, access to Yellowbrick is completely free. Try it for yourself. Simply go to joinyellowbrick.com and search a company or ticker you're interested in. You're bound to find a great report on just about any company. That's joinyellowbrick.com.
Yeah, I've kind of evolved on this a little bit. So when I first started picking individual stocks, there was like the two-sided goals. Number one was, I got to start saving money. I've got to start investing. That was at that point in life where it's like, I'm not a 20-something anymore, just out partying. I really need to be thinking about my future. So that was kind of the beginning. But then buying stocks, it's like, okay, I can beat the market. I can do better. I can do better than the way most people do it. And what I've learned over time is that beating the market's really, it's a fine aspiration, but I don't think it's necessarily a healthy goal, because it can lead to bad outcomes because you're trying to make up for mistakes sometimes, versus just trying to make the best decision to make now. Now, I want to be clear here. Like, this is something I wrote about this weekend. I pick individual stocks because I think I can do better than buying an index. I want to be clear about that. But that's not all I'm doing anymore with individual stocks that I buy. Like Realty Income, for example. I don't expect Realty Income is going to beat the market, but I think a 6% yield and a little bit of growth in that dividend every year, it's going to be a better wealth generator over the long term than owning bonds. It's still going to be volatile like stocks are, but I think it's better over the long term than owning bonds, right? So it's in between stocks and bonds. So it serves a purpose in my portfolio. So every investment that I make serves a specific purpose, right? Most of the stocks I'm buying, I anticipate that they should be able to do better than the market. If they can't, then they're going to do better than bonds or, whatever reason that I'm buying them. And then I further divide it up a little bit beyond that barbell of, here's the dividend growth end of it, and here's like the buying for wealth generation and growth part of it, is I've got that kind of smaller part of it, like where the QuantumScapes and Rocket Labs live. These are the more speculative investments that I'm probably going to have a lot of money losers there. But if I do get one that's a 5X or even like a 50X, if you get really super lucky and you find the one. But the biggest thing, like I talked about at the beginning of the show, the thing that's changed for me over the past year is I now exclusively manage and measure success based on those financial goals, right?
Yeah, I'm glad you said that, because this is something I think about a lot. So because I started out investing in a retirement account in a fund, I had no idea what it was. I've never beat the market, right? Like if you're going to, unless you're investing in a literal S&P index fund or some super aggressive 100% equity fund, most people are in funds that are a mix of things, like in their retirement accounts, I would imagine. So if you look back at if you're one of those people, you're in some mutual fund and it's a mix of stocks and bonds, or you're in a bunch of different funds within your retirement account, chances are if you take your performance and stack it up against the S&P 500, you're lagging it. So from age 22 to now, if I look at our entire invested wealth and I measured it, if I could even do this, against the S&P 500, like for every single buy every 2 weeks of all of our retirement accounts against what the S&P do since then, I guarantee you we are trailing the market. But here I am, age 45, absolutely on target for both of us to retire at normal age, if not a little early, and be totally fine. And that's excluding my pension income.
Yeah.
Right. I am living proof that by being at least mildly intelligent investor, but doing it consistently for 25 years so far and counting, you can still reach your financial goals. So that gave me a whole different frame when I started buying individual stocks, at not being obsessed with beating the market. Like you, I think and hope I can, right? In the stock portion of my portfolio, my goal is to beat the market. But I guess the way I think about it is, okay, well, what would I be doing with that money if I wasn't buying stocks? I would be either spending it on stuff. Oops, did a little thumbs up there. I would be either spending it on stuff, I would be saving it in a savings account, or it would be going to my index fund retirement accounts. All three of those other options are going to lag the market anyway.
Right.
So I don't know, I think that's a benefit that I just sort of grew into it this way, and that's the way I see it. I don't know if you took what I know now and stuck it in my 22-year-old brain, if I would start out this way.
No. Well,
or think about this. Or even if I was 22 now.
Yeah.
Yeah.
This is not to knock the experience of youth, but I mean, there is something to be said for the knowledge that you gain by living it, right? Versus just learning something. So yeah, that's something I've learned the hard way. And I'll say I'm in Fidelity right now. I'm looking at the actual returns. So I haven't been in Fidelity. I think I opened my solo 401k at the end of 2015. I started off 2016 in it, but let's see if I get this right. So the 10-year CAGR, now this factors every buy along the way weighted against the S&P from the day of that buy, right? So it's about 14.5% weighted since the beginning of 2016. Over the past 10 years, so it's a little bit shorter period of time, or a little bit longer period of time, the S&P's up, the S&P's CAGR is like 13.3%. So I've pretty consistently beat the market. That works out to about 7 or 8% better than the market over the long term. It's hard to do considering that a lot of that time I've not owned the mega caps, right? I owned Microsoft and I owned Apple for a while. I've owned Alphabet in the past, but really over the past 3 or 4 years, especially, I haven't owned those large companies, and I've still managed to do a little bit better than the market over the long term. Now, here's the thing. I wrote about that. I'm talking about some stuff I wrote in last week's newsletter. So if you read the newsletter, I'm being a little bit repetitive here, but for those of you that don't, these are the kind of insights that you can get. You should sign up for our newsletter at investingunscripted.com.
Nice organic plug. Well done.
That's good, wasn't it? That's good. Not clunky at all. But no, just the past 3 years, the CAGR of the S&P 500's 11.4%. So again, a little bit above long-term averages. And that's even with that big drawdown we saw. It was the first year of that. The past 2 years have been so good. My CAGR over that same period of time, 3.3% over the past 3 years. Yet I've still, over the, call it in past 9 years, have outperformed the market over the long term. And again, a lot of this is heavily weighted by some really dumb investments that I made at the peak in 2021. And then this big transition that I've undergone more recently it's going to weigh on my performance in the portfolio because it's going to be measured against the S&P even when some of those investments are going to be bonds and cash.
Right.
So again, I know what I'm trying to get. I know what I'm trying to get to, and that's far more important than knowing what I'm trying to beat.
Yeah. No, that's exactly that's the thing. Like when I do start to question myself, this is a lot of what I did in 2022. When we recorded the episode, I don't know how to invest anymore. A lot of what I tried to do to get myself kind of through that thinking was just remember that I'm on track. I'm fine. Everything's going to be fine. Like.
No, exactly. That's exactly
because
right.
It's the long-term goal. It's not beating the market. That's not a goal.
Yeah. You remember the episode we did, goals versus incentives?
Yeah. It's that whole thing. Yep.
It really, really is. And anybody that hasn't listened to it, I want to encourage you to go find that one. If you just Google search it, you'll be able to find it back in the library. And are you looking it up?
Yeah, I'll look it up while you're talking.
Okay. But the whole point of that episode was there's what our goals are, right? And we kind of used like the backdrop of thinking about you're the management of a company or you're the employee of a company. There's the company's goals, right? That they publish and what they're trying to do. And then there's the incentives that affect your decisions. And for most people, those incentives are going to be tied to the things that they're compensated on. And
yeah,
we broke that apart in that episode. But one of the things that we talked about is like a big incentive for a lot of people is like how they're viewed by their peers and their spouse. And if you're not very aligned with your spouse when it comes to managing your investments and portfolio, if the decisions you make cause the portfolio to go down, you're probably going to make some really stupid decisions to try to fix that because your incentives are to hide it from your spouse until it looks good again.
Right.
What episode was that, Jeff?
49.
Episode 49.
I want to go back and check out. So I want to go in a little bit of a different direction here because you talk about this a lot, like the barbell approach you take with your portfolio, but also you just mentioned a few minutes ago, owning a dividend paying stock like Realty Income, not so much for its potential to multi-bag, but for the dividend yield and the stability with a little bit of growth. One of the things I have thought about in terms of what I might do differently in 2025 is, do I want to be a little bit more conscious of buying dividend paying stocks in my portfolio? And my struggle with this is twofold. One, I'm still trying to have less stocks, not more.
Yeah.
But about once or twice a year, I end up buying a new one, and I don't sell as much as I used to. And I actually like my portfolio. Like, of all the stocks I own, there's maybe a few that I have low conviction in and haven't sold yet, but everything else I have medium to high conviction in. Even some that I haven't added to in a long time, they're just a little bit of money and they're doing fine. But I guess my question is, like, how do you think about, for someone, let's say I did decide, all right, I'm going to make a conscious effort over the next year to really pivot my stock investing money towards dividend paying stocks. Do you have any ideas of like how to go about doing that? I feel like if I just tell myself I'm going to buy more stocks that pay dividends, I'm going to end up making bad investing decisions just because I want dividend yield. So I guess the one thing I know I could do is just keep adding to the dividend paying stocks I already own. But I'm curious if you have any other thoughts about that.
I do, Jeff, because this is something that I've gone through myself as part of my evolution as an investor. I think as a starting point, the biggest mistake a lot of people make when they start buying dividend stocks or making a transition is they're too focused on yield. And often that leads you down the path of yield traps. Buying, and I've done this myself to some degree, but you find what looks like a great company, like a 3M, that they increase its dividend every year for more than a half a century. And you're buying because the yield's really high and you're like, well, hey, it's 3M. What could go wrong? A lot of things went wrong and the yield got cut. AT&T is another example. It's easy to fall into those traps, focusing too much on yield, when the better thing to focus on are generally younger companies that have a good track record of growing their earnings per share at really high rates, because they will grow their dividend at really high rates too. You look at a lot of these older companies that have these really long track records of growing their dividends. They grow them at little tiny percentages, like less than 1%, which doesn't even come close to even matching inflation, right? So you're losing value over time. And their earnings per share growth rates are generally really low too. So you have to find companies that have proven that they're still going to be able to grow their earnings at really high rates, because that's what's going to pay for the dividend growth over the long term, and not getting caught up in trying to chase turnarounds and catch super value. It's just like buying great growth stocks. You want to buy really, really good businesses, right? If you buy really, really good businesses that have moats and grow their earnings, you're going to own really good dividend stocks.
Yeah. It also just seems daunting, because when you think about, I like the idea of having significant dividend income in retirement.
Yeah.
Like I like the idea of like, oh, maybe I can match my salary from when I was working just in dividends, right? But then you start to do the math and you're like, oh my God, I'd have to have so much money in these dividend paying stocks, like to get tens or hundreds of thousands of dollars, whatever you want in income. But I guess the flip side of that is that's a reason to start accumulating those types of stocks when you're 45 and not when you're 65. So you have a chance of building up towards that. I think for me, I just need to, it's going to end up being, I need to expand my universe of stocks that I cover and think about and know.
Yeah.
And I just have to do some work on some new dividend paying stocks. So a little bit, I do such a good job, I think, of like keeping track of the 40-ish stocks I do own. It feels like daunting to start to keep track of more, but yeah. I think that's what I'm going to have to do.
Let me tell you a secret. Here's how you can get a 10% yield on Apple.
Go back
Buy
in time.
In 2011 when it's about $10 a share, split adjusted, and the $1 a share annualized that you get today. This is something Brian Feroldi said to me years ago, and he said it publicly. So he didn't only tell me; he's told other people too. Like everybody, anybody that will listen to him, he's told them, and even the people that won't listen to him, he's told them too. Sometimes your best dividend stocks in the future, are the best growth stocks you're buying today.
Yeah.
Think about the companies that have started paying dividends over the past year.
Meta, Google, or Alphabet.
Salesforce is another one.
I think another good thing to remember is like the yield will change, but it stays for the price you bought the stock at.
Right. So your yield on cost.
Right. For example, you mentioned Realty Income a few minutes ago, and that's on my mind because I was just looking at it recently. I wrote an article about it. And the yield right now is around 6%, which is pretty good. And I have high confidence that company can support that dividend. They're a dividend aristocrat. They've raised it every year for 30 years, I think. I think pretty recession resilient in their portfolio of real estate that they own, that they lease out to different companies. So if I buy a whole bunch of it right now, I'm going to get 6% on those shares forever, unless they actually lower the dividend over time. But like you lock in at that yield
your cost
the
basis.
day you buy.
Right.
Yeah.
That's why I mentioned it earlier. Is like that kind of that in between, owning bonds and owning stocks mainly for growth. Now, of course, the risks are still volatile. So if you're part of your idea behind buying the bond is when it matures in 5 years, you're going to get your cash. With stocks, any stock, you're still risking the volatility. The price is going to come down. But if you're just focusing on it for that income and you anticipate holding it for very long periods of time, building a diversified portfolio of higher yield, really stable, growing their income businesses, I think it's a smart approach. One more thing I want to say about dividend stocks before we move on is I started off talking about the risk of dividend traps, where like you go whole hog and trying to find like the deep value, best opportunities you can. And then I pivoted and said, that's where you find the traps. You focus on the ones growing earnings, and that's where you're going to find the ones growing the dividends. There's still a middle path of valuation. I think valuation matters far more for these because they're generally more stable businesses.
Right.
And they aren't growing it.
They're not going to grow themselves out of a high valuation.
25-30%. Right. Exactly. Where you can pay a premium and still get a great investment because it grows into it. Paying a good valuation still matters a ton. Okay, Jeff, I'm going to ask you one more question. This is the unscripted part of the program here as we get ready to wrap it up. What is, if you were to look at your investing life, is there a single thing that you think you should resolve to do differently or to do more of in 2025?
Oh, that's a good question. It's such a cop-out answer. Actually, maybe it's not. One of the things I've been struggling with over the past year is I feel like I'm not learning at the same rate I used to, if that makes sense.
Yeah.
And I think some of that's normal, right? Like
of course,
the rate that you learn when you're new to something, slows down exponentially if you start off really fast with it. But like, when I think about where I was in 2020, I was like voraciously consuming books and articles and podcasts and YouTube channels and newsletters online to try to learn everything I could about investing in stocks, like everything from like, what is a P/E? Like, what does that mean? Like I knew nothing. And it was fun. I felt like I was really like learning a brand new skill from scratch. And because I've learned a bunch, thankfully, but also because a lot of my time goes into asking my questions that I want to know out loud to you and hundreds of people who listen, I feel like I haven't sat down to make myself learn something new in a while as it pertains to investing. So I think one thing I want to try to do this year is find some area of investing I don't know enough about and learn more about it, whether it's a specific sector or industry or more about valuing companies or more about portfolio management. I don't know, something. Because that's the thing I feel like has been missing from my life the last year or two.
Hey, Jeff.
What about you?
Let's before we talk about me, let's sit down and talk about banks sometime. What do you say?
No. Here's what I can tell you. I have resolved in 2025 to not learn about banks.
All right. So about me, I think, and I asked you that question because this is a question that I've been asking myself to really kind of focus. And I want to compliment you because I think one of the things that's happened for you over the past year, especially, is you transition from knowledge accumulation to actionable insights, where the things that you're learning now are built off of that foundation that you now have, that now you can take that new piece of information, you can consolidate it into your process, and you can use it to make a better decision. You didn't know what decisions to make a few years ago, right? You didn't. So now you can use every piece of information to make an actionable decision.
So I think it's not like I'm not learning now. It's like I'm learning by doing and learning from experience. I think I want to find some book learning. I think maybe that's another way to think of it.
Hey Jeff, let's read some books about banks together. What do you say?
For the listeners, Jason knows that I have a love-hate relationship with banks in the sense that I love to hate them.
Yes.
So he's constantly trying to get me to talk and think about banks, and I refuse.
Yeah, that's okay. That's all right. All right. So I think for me, it's really defining better some of the new strategies that I've implemented in my portfolio and making sure that I'm putting them in buckets that they fit in and not letting them spill over into other aspects of my portfolio. I think this is especially important with something like options because it can consume a portfolio really quickly in good and bad ways. So I think that's the big thing, is making sure that I'm really compartmentalizing the way that I'm thinking about these different tools so that I'm still being mindful of what my long-term goals are without risking either becoming too conservative or letting other aspects like options where there can be risk can sneak up on you without letting that offset the safety that I'm building in other areas. That's probably the biggest thing that I'm resolving to do this year.
That resonates with me because I'm glad I didn't start messing around with options like you and I are both doing now until I was several years into understanding how investing worked, because it not only is it like you can blow yourself up quickly in two ways with options. One is simply not fully understanding and making a mistake because it's complicated. And then there's also just you have a couple successful options trades in a row and you think you're a options trading genius.
Yeah.
But it's a little bit different than like thinking that about just regular stock investing. There's a little bit more risk involved. So I would say the same for me now that you mentioned it, but I think that's a good thing to focus on for you as well.
All right. Shall we end it here?
Let's do that.
All right. Okay, friends. Again, happiest of New Year's to you. May your 2025 be filled with investing success, and I hope that Investing Unscripted continues to be a part of that. But as always, talking about us or talking about our answers, our thoughts, it is up to you to find your own It is up to you to find your own answers to these complicated, complex questions about investing, personal finance, and reaching your own goals. But you know what? You can do it. I believe in you. All right, Jeff. We will see you next time.
See you next time.